Welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I am Zach Seward, filling in this week for Christine Lee, and joining me is my co-host, managing editor of Global Capital Markets, Lawrence Lewitton. Hey, Lawrence, how you doing?
Hey, Zach, how are you?
I'm hanging in there. Let's take a look at Bitcoin, shall we?
Let's.
All right, Bitcoin is trading at $47,917, up slightly in the past 24. Let's move now to Ether. The CoinDesk Ether price index ETX is at 3,430, up about 8% in the last 24 hours. And lastly, a look at CoinDesk's DeFi index, DFX, sitting now at $689.50. Lawrence, what is happening in the markets? What are you seeing and what are you paying attention to today?
Oh, look at ETH. I mean, it's up today, as are some of the alts. And that's telling us that and we're looking at Bitcoin being flat to down a little bit throughout the day. So that's telling us that at least the continuation of flows going out of Bitcoin, going into things like ETH, going into the alts, going into all sorts of stuff. So it's the narratives inside the market itself are dictating what's happening now. It's a little bit different than this idea of global macroeconomics dictating what's happening in the crypto markets. And how about you, Zach? What about you? What are you looking at here today?
Well, I'm taking a peek at this FTX US acquisition of LedgerX, which I think is really interesting. FTX, obviously the crypto exchange helmed by Sam Bankman-Fried. LedgerX, a crypto derivatives platform that hasn't really found its footing, even though it's been around for a couple of years. Interesting to see that whether or not under FTX US, LedgerX can bring crypto derivatives to US traders, which has been a pretty tricky needle to thread on the regulatory front. So we'll talk a bit more about that one later on with Nick Day, and I'm looking forward to it. So we're going to pause now for the CoinDesk Spotlight.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Turning now to our first guest, Caitlin Long, the pioneering founder and CEO of Avanti Bank. Some would say Long is largely responsible for making Wyoming a crypto-friendly state, helping to pass dozens of laws that are favorable to the industry. After obtaining Avanti's special purpose banking charter, now her organization is applying to become a Federal Reserve member bank. Here to discuss the news is Caitlin Long herself. Welcome to the show, Caitlin. How are you doing?
Hey, good morning, guys. Thanks for having me on.
We are very excited to have you here. I guess my first question is why do this? Why join the Fed? Isn't that sort of antithetical to what Bitcoin is supposed to be all about?
The whole purpose of creating a bank in the first place is to ensure that there are sufficient US dollar services to the crypto industry. The crypto industry now has far in excess of $2 trillion in it, and the US dollar deposit capacity in the industry is only about 80 billion. And obviously not growing anywhere nearly as fast as the crypto industry assets are growing. So that was the basic reason for setting up the Wyoming SPDI charters. There are more technical reasons having to do with risk. There's actually a lot more risk in having traditional banks provide US dollar services to crypto companies than there is having crypto companies be able to work directly with the Fed due to the settlement differences between crypto and US dollars, which are vast. And right now, those risks are being unmonitored because all of the crypto activities are conducted through third-party banks.
So what happens should you get that approval? What happens to your business? What changes? What makes it different then?
Well, for one thing, we're not launched yet. None of the Wyoming SPDIs. There are 4 of us chartered now, more coming. None of us are launched yet. But for Avanti, the reason why we pulled the trigger on the membership application was simply to become directly regulated by the Federal Reserve itself. Most of the banks in the United States are actually state banks. And the way that it works is your state chartering authority is your primary regulator. And then most state banks are regulated by either the FDIC or the Fed, and they choose which of the 2 regulators. And in our case, it made sense because of the systemic implications for crypto to be directly regulated by the Fed. So it took an issue off the table and puts us into that vaunted category of Federal Reserve member banks, which is the most prestigious group of banks, those namely that have Federal Reserve master accounts and are members of the Federal Reserve.
So what changes in terms of, you were talking about settlement risk being a problem when it comes to traditional banks getting involved in crypto. What changes for you? Will that cause it? Will you, for instance, will Avanti then face that same kind of risk? What's different for you compared to those guys?
Yeah, that's a very good question. Very astute. The most traditional banks don't have the IT platforms to be able to handle crypto. That's a fact. Most of them only settle their books and records once a day. And as you know, Bitcoin settles every 10 minutes on average. Ether settles every 3 minutes on average. A number of other cryptos settle much faster than that. And so a bank can really get itself into trouble intraday. And the Federal Reserve, most folks know it mostly for the FOMC and setting monetary policy. But the vast majority of people who work at the Federal Reserve are bank supervisors. And what their job is to protect the payment system against a bank defaulting on the Fed itself. The Fed is just a bank that banks banks. And the biggest risk is, from the Federal Reserve's perspective, is that a bank defaults on the Fed. And there's actually a lot of what's called payment system risk, default risk by a bank, because of these settlement risk issues. And the banks just don't have the IT systems to be able to settle their books and records and reconcile them intraday on a minute-by-minute basis. Most of them are set up only to do it once a day. And Avanti will have an API-first technology architecture, which, again, most banks don't have. But it's such an obvious thing in the crypto world. You've got to be able to make API calls to have fast transactions. And if the banks can't offer that, then they really have no business being in crypto, and because they can get themselves in a leveraged position intraday and not even know it until they reconcile their books and records overnight. There's a huge tech upgrade cycle coming to the U.S. banking industry as a result of all of this. And it's also worth saying it's not just crypto that's going to drive it, although that's part of it. It's also the fact that the Fed will be offering faster payments called FedNow beginning in 2023 or 2024. And the banks are not going to be able to get away with only reconciling their books and records once a day and not having APIs once that happens.
So do your regulations get... Oh, I'll let you go. Yeah.
You got it. You got it.
Oh, I was just going to ask, are your regulations going to change compared to what's going on right now in Wyoming, which you helped orchestrate? Do you become more regulated than you would otherwise be if you stayed in Wyoming and didn't go to the Fed?
No, that's another good question. The answer is no, because Avanti set ourselves up to meet all of the federal banking laws. And we were just informally set up to meet all of the federal banking laws. We knew the Federal Reserve would want us to, even though there are some things about the Wyoming statute that don't require a submission to federal banking laws. We did submit to those. However, what this does is it just formalizes what we had already informally submitted to, which is federal banking laws, especially those applying to capital, as well as those applying to all of the compliance and bank supervision risks. What will happen now is if the Federal Reserve does grant our membership application, the way state chartered banks are supervised is the state regulator is primary, and then as I said, the FDIC or the Fed is secondary. And then every other year, the state regulator leads the regulatory exam. And then the other year, the federal regulator, i.e. the Fed or the FDIC, leads the regulatory exam, and they switch off, they work together. So what will happen is we'll actually be formally regulated by the Fed. Again, it's more belt and suspenders than necessary. We didn't need to do this, but it certainly makes things easier for the Fed because we look a lot more like a traditional bank to them, having met all of the same capital requirements as the traditional banks.
So stepping back a bit, this has been the summer of crypto on Capitol Hill, which many see as sort of a watershed moment. I know you've been outspoken on the issues around the infrastructure bill. So I wanted to zoom out a little bit and get your take on some of the federal level regulation going around relating to the crypto industry at this point in time. I'm just going to ask you straight up. I want you to rank SEC Chair Gary Gensler's performance to date as it relates to crypto regulation. What's your current thinking on how well he's handled that role?
Well, gosh, he hasn't done anything yet. He's said a few things. He's made some speeches, but he hasn't actually done much yet. And so I think we're waiting for that. He was pretty, in his confirmation hearings, he was pretty clear that he felt that Congress needed to clarify these laws. He wasn't going to overreach relative to the SEC's jurisdiction. And we haven't seen him do that yet. He's asking Congress to clarify. And I do believe that there will be something coming out in September. The Federal Reserve is working on a paper. We thought there might be a chance that Chair Jay Powell would release it at Jackson Hole last Friday. He did not. He didn't even mention crypto or stablecoins. But in his most recent testimony on Capitol Hill in July, he did say there is a paper coming out in September. I believe it's coming from the Boston Fed, looking at CBDCs and private stablecoins and the systemic risks that the Boston Fed President Rosengren has been talking about relating to stablecoins. And it's worth, to your broader question, it's worth underscoring when Chairman Powell said that he thought stablecoins should be regulated as either bank deposits or money market funds, that says either that crypto companies in the US that issue stablecoins will either have to be chartered banks or registered as money market funds. And I think that's pretty logical. That seems to be where things are going in the US. What's fun about what Wyoming did is it doesn't require any congressional authority. It's already there, wrapped up in a bow, ready for the DC folks to approve, and doesn't require any congressional action. Either of the other actions that Chairman Powell was alluding to will require congressional action, because if stablecoins are traded as they are today outside of broker-dealers, that is going to require a change to securities laws. Right now, in order to trade securities, you have to go through a broker-dealer or you have to be registered in some way with the SEC. And so having the ability to take what is effectively a money market fund or an ETF and trade it among consumers, that's new and different. That will require congressional authority. Same thing for the federal banks. They don't have authority to do what the Wyoming banks have authority to do. And so here's, again, just to underscore, Washington, D.C. already has the regulatory tools to bring stablecoins inside the banking system. It's called the Wyoming Special Purpose Depository Institutions, and they've had the ability to do this since October. And it just remains to be seen. Now we're heading into a period where all of this, I think, will be coming to a crescendo, and you will probably see action on a number of fronts coming out of D.C. in that September-October period.
Yeah, I wanted to home in on the stablecoin stuff because I know at Avanti there's the AVIT, which my understanding of the AVIT is more of a back-end systems. Are there any stablecoin plans for Avanti that we should be aware of? Are there any sort of consumer-facing stablecoin plays that you see in Avanti's future? Really curious as the stablecoin sector seems to surge in these last few months.
Sure. Avanti is not looking to issue a stablecoin. We are looking to issue something that is structurally very different, but to your point, uses the same technology as stablecoins. The structure of AVIT is a bank product. It is the functional equivalent of a digital cashier's check. And a digital cashier's check can be endorsed over to an infinite number of owners, just the way stablecoins work. And so the idea here is if this is a bank issued product, it takes away a lot of the legal and regulatory, as well as accounting and even possibly tax risk that exists with existing stablecoins. Existing stablecoins, that's phenomenal technology. I've saluted the market for creating that technology. However, mainstream users really struggle to use those because there's no regulatory certainty and legal certainty. If you can't be clear that you have clear legal title to your asset, then mainstream users, especially a fiduciary asset manager, just can't take the risk to trade those assets. And moreover, because of some of the structural features of stablecoins, they're not structured to be cash equivalents under US GAAP. And most likely, again, the IRS has never said anything in the US about the tax consequences of stablecoins. But most tax advisors, if you read what they've analyzed, stablecoins are actually crypto assets. And every time you use them, they trigger a tax reporting obligation. Even though the amount of the tax may be minuscule, it's whatever the decimal point difference between $1 and the price at which you bought or sold a stablecoin. It's nonetheless a headache from a tax reporting obligation. Those are again, I can't give legal or tax advice, but I think the stablecoin issuers, especially USDC, gives a pretty clear warning that it's not clear what the legal and regulatory status of USDC is, and frankly that there's no clear legal and regulatory status for it anywhere in the world. And I don't mean to single them out. I think their attorneys just being responsible in warning the users that there's a lot of regulatory risk. And so what we're doing is looking to clarify that regulatory risk for these types of products, get them inside the banking system. It actually helps the Federal Reserve from a monetary policy perspective because you're not trapping collateral outside of the banking system. That's a wonky argument. If you want to dig into that one, I spoke about that at the Cato Institute last November.
Yeah, so getting to that, you've been describing what is currently in place, the system. What should be done with stablecoins? I mean, should they be allowed to hold securities to back them? Is that the ultimate revolution in what stablecoins are about? The fact that they can be money market funds that trade as if they're $1. What's wrong with that? Is there anything wrong with that? Should it be a different class? What's your opinion?
Well, it comes down to whether the stablecoin issuers are inside the Federal Reserve System or not. So if they're securities, if they're money market funds or ETFs, then they're not inside the Federal Reserve System and don't have direct access to the payment system and can't issue them as a bank instrument. Again, getting the cash equivalent treatment and legal and regulatory clarity of issuing them as a bank instrument. If they're inside of a bank, then the question is, what's the regulatory capital? All of the other compliance and supervision functions are easy to comply with once you become a bank. I'm not saying they're easy to comply with, but once you become a bank, it's very clear what the obligations are. The capital is the big one. And here, I actually take the side of the banks. If non-banks are going to be accessing the payment system, they need to be subject to the same capital and supervision and compliance requirements as the banks. Otherwise, why would anyone become a bank? And so right now, the only types of institutions in the United States that can bank at the Fed, in other words, that can get what's called a master account at the Fed and get direct access to the payment system so they can clear US dollars, there are only two types of institutions that can do that. One is FDIC-insured banks, and the other is depository institutions eligible for FDIC insurance. Avanti falls into that second category. Stablecoin issuers don't fall into either category right now. So again, Congress would have to change the rules. But if Congress relaxes the rules for stablecoin issuers so that they're not subject to the same rules as traditional banks and depository institutions, then I can see why there's going to be a big fight. And it may be very difficult for Congress to get any rule change through. What we're presenting is, hey, we're a bank that's a depository institution eligible for insurance. So we check that second box, and we're subject to all the same rules as traditional banks. So if that's the case, and we're willing to pay all that freight as the same as traditional depository institutions, then let us in. That's the choice that we've given the Federal Reserve.
Very interesting reading between the lines here to get a perspective on the opportunity at play. Good stuff. Thank you so much, Caitlin, for joining us. We really appreciate your time.
My pleasure. Have a great day, everyone.
Thanks. That was Caitlin Long, the CEO and founder of Avanti Bank. Coming up, we are going to check in on Asia and the crypto markets. Stick with us. It's First Mover. Time now for the daily forecast to see what is happening in the Asia crypto markets. Here is Angie Lau of Forecast News with the latest.
Welcome to the Daily Forecast, August 31st, 2021. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. So much to cover today. One that's uniquely, well, China. A Chinese internet company which started out in gaming that did a 180 into mining crypto has made yet another move, this time into NFTs. The heat and big money behind non-fungible tokens is far from cooling off, and China's just the tip of the iceberg. That and more coming up. Let's get you up to speed from Asia to the world. First up, China-based The Nine has announced that it is stepping into the NFT business with the launch of NFT Star. The platform is set to sell NFT collections featuring global stars. While China's central bank has vowed to keep the pressure on cryptocurrency and speculative trading, NFTs actually have not faced any political backlash in the country. So, looks like this is another sign of that market shifting up a gear. Forecast News' Timmy Shen reports.
NFT Star, a wholly owned subsidiary of The Nine, will be based in Singapore and expects to launch in the fourth quarter. The company is offering incentives to those who signed up early. And while global sports stars will be the main partners initially, more collections from the entertainment and arts worlds are expected to follow. The platform says it will accept payments from credit cards to make it easier for mainstream consumers to get involved. For Forecast News, I'm Timmy Shan, Taipei, Taiwan.
Meanwhile, in Korea, 3 major crypto exchanges are getting ready to follow international anti-money laundering rules. And they're working together on this to figure out a way to abide by the Financial Action Task Force's travel rule. That's the FATF travel rule. Now, the joint effort is called CODE, short for Connect Digital Exchanges, and it's a joint venture by BitThumb, CoinOne, and Corbett in South Korea. Forecast News reporter Danny Park has more.
Travel Rule is the Financial Action Task Force's guideline for virtual asset service providers, an effort to combat global money laundering and terrorist financing. It requires exchanges to collect information on senders and receivers of crypto transactions of $1,000 or more. Korea's Financial Services Commission applies the requirement to any crypto transactions of over $1 million, or about $860. It has given exchanges until March 25th to construct the travel rule system. Code aims to build a solution to serve any exchange that wants to comply with this international standard. However, as none of the 3 exchanges have been qualified by the FSC as legitimate crypto operators, they face the risk of being closed down if they don't meet the new regulations before September 24th. Unless that happens first, we may not get to see code in action. For Forecast News, I'm Danny Park.
Now, over in Hong Kong, the Securities and Futures Commission, or the SFC, has warned that digital tokens and initial coin offerings, or ICOs, could be involved in unauthorized collective investment schemes. Okay, so what are we talking about? Well, the SFC's warning comes as Labs token, a token for fractional investments into real estate projects, was added to the SFC's suspected unauthorized CIS alert list on the same day. Now, professional investors, or those with more than $1 million in their portfolio, are legally allowed to invest in unauthorized collective investment schemes. But the SFC has urged investors to exercise extreme caution and to do their own due diligence before investing. And finally today, looks like you are never too young to make money from NFTs. I can't wait to introduce you to this young lady in India. 13-year-old Laya Mathak from Chennai has already made around $40,000 selling her works as NFTs. Now that's almost enough to buy a house in her home city. Now, she started out exploring how to create digital art by watching online tutorials and has not looked back since she learned how to mint her works as NFTs.
When I was 9, I started with art, like basic paintings and drawings and portraits. When I was 11, I started with programming and stuff. And in this pandemic, I had a lot of time, so kind of tried to integrate both art and tech, both of my 2 favorite hobbies together.
But it is a great reminder, it's never too early or late to start anything. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
All right, let's check the numbers again. Let's take a look at Bitcoin, see how it's doing. Pretty flat, 47,840 according to the CoinDesk Bitcoin price XPX index. Let's take a look at Ether. Ether, how you doing? 3,426, definitely up a bit sharply in overnight trading. And we'll take a peek at the DeFi index, DFX, sitting now at 689.47, now 691.40. And that should be moving throughout the day. Shifting to the world of DeFi, we are going to discuss crypto markets and other news with John Wu. He's the president of AVALabs. Welcome to First Mover, John. How are you today?
I'm well. Zach, Lawrence, how are you?
We're doing good. We're hanging in there. So I wanted to talk about NFTs. NFTs remain very exciting. They're kind of becoming table stakes for any base layer, including Avalanche, of which AVALabs is intimately involved. What's your view of why NFTs remain really exciting to people in the crypto market now?
Sure. So there's been a lot of news about NFTs. In fact, AVALabs, the software and licensing firm behind Avalanche, today there was news out that we're working with Topps and Major League Baseball to create NFTs for them. You just had a great segment on Asia and how some young kid was able to create a business out of her art. All of these things are an indication, and you started the segment off talking about DeFi. So what is important about all this is basically utility on the blockchain, utility on Ethereum, utility on all the alternatives such as AVAX or Avalanche. And I think we started out the broadcast, I heard Lauren say that it's kind of like alt season. And the reason that is all happening, in my opinion, is because of DeFi, because of NFT, people sense and see finally real use cases. 150 billion in TVL in the DeFi world. You've got a couple of unicorn companies in the NFT market. We're talking about social tokens. All of these are actual use cases and people are excited about it. And that's why there's a run in the alts.
Hey, I wanted to focus in on this MLB news that you just shared with us. I hadn't even seen that one, so that's pretty cool. I know that MLB launched their first NFT platform on the Wax blockchain, and I think they had some hiccups at launch. So I'm curious as to how that ended up migrating over to Avalanche, and if you could share a bit more detail about how that choice contract was snagged.
Sure. So the partnership is with Topps, who has a license agreement with MLB to create these digital collectibles. I think they did start on Wax, but going back to the core principles of why anyone, whether it's in DeFi, whether it's a user or a dApp, comes and basically develops and uses the Avalanche platform, it's because the protocol has achieved certain things that hopefully ETH 2.0 will achieve for Ethereum. It is fast, it's scalable, the finality is less than 2 seconds and less than 1 second most of the time. So when you have something like that, ultimately you have lower costs to mint things and you have a more stable platform. So that's the reason why anyone, whether it's DeFi or whether it's NFT, wants to come over and use the Avalanche platform.
John, I wanted to ask you what was causing DeFi's recent run-up, at least. But before we do, getting back to Zach's point, what exactly is this Topps deal going to look like? What are you providing? What are people going to be able to buy? Are they going to buy, virtual baseball cards with their favorite players, or old baseball cards from previous years? What is this going to look like?
So there's two questions there. The first one, from a user perspective, what they can buy, it is going to be incredible. What you've seen in other platforms, I can't go into specifics because I am not Topps, so we'll let them do that. But what you see in other platforms and what you can create with the rights to individuals who are baseball players or moments in baseball games or events, you'll see the same type of NFT capability on the Topps platform. What Avalanche has done for the NFT marketplace is Avalanche has created a unique platform where you can actually, it's almost like a hybrid. In certain NFT platforms, you've abstracted away the entire blockchain experience, and others are very blockchain native. So on one hand, you have to fiat on board, and you don't even actually know where on the blockchain to look to see your NFT. On the other hand, it's all crypto to crypto, and you hold it in a wallet. It's self-custody. The platform of the infrastructure for NFT that Avalanche has and that AVALabs created is something that gives everyone their choice. If you want self-custody, you can have that. If you want to purchase with crypto in a box, you can do that. If you want to do it through dollars and a dollar on-ramp and dollar off-ramp, you can do that. That value proposition really doesn't exist right now.
So I think the TOPS contract, that's a good episode in the battle for the base layer. So I wanted to change gears a little bit. I could talk baseball all day, but I did want to go to the world of DeFi because I think there's a lot of interesting stuff going on in DeFi for sure. You guys rolled out the Avalanche Rush program, $180 million in incentives. And we've seen other base layers follow suit in the last week with Cello, Phantom rolling out similar incentive programs to attract DeFi users and builders to these networks. I guess I wanted to just zoom out just in really basic terms. When you're explaining to your, let's say your mom or your aunt or your friend or your coworker who may not be crypto native or crypto savvy, if you were to explain what this concept of liquidity mining is and why it's very powerful for moving people around the DeFi ecosystem, what's your best way to describe that in simple terms?
Sure. So if I were to explain it to the whole system, the Avalanche Rush is what you're talking about in terms of the 180 million. It's actually, in plain English, it is basically a user and application acquisition program. It is no different from when Uber used to give out $30 for people to go and take rides. The only difference here is in Uber's case, they created their own technology all by themselves, and they're just incentivizing the user to use it. In these programs, such as liquidity mining programs and so forth, what you're doing is actually you're incentivizing two parties, the user and the dApp developer, to both come into the ecosystem. And then you have these compounding loops of success, and you have tremendous growth, as we've actually seen in the TVL of Avalanche just in the last 10 days to well over 2 billion now.
John, do you think these kind of incentives maybe will raise red flags with regulators? People might worry that it gets too close to even becoming a type of security almost. Is there any concern on your part that this might get a little too close to what for comfort for regulators?
Well, one of the reasons why, Avalanche, the foundation, did not launch this sooner was because we vetted it with, all the best lawyers. Our in-house counsel is one of the best as well. It depends on how you do it. And, if you do it in a way that's no different from my example of Uber giving $30 out for people to use a real use case and having utility, then any problems you run into, Uber in theory should have the same problems. There are other ways to do it, not the way we did it, that could be construed as it's more of a security, and then that would run into issues.
Very interesting stuff. Thank you, John. Always interesting to talk DeFi, base layers, and all the interesting stuff that's going on as we see people migrate over to Avalanche. Good times. Thanks for joining us on First Mover.
Thank you. It's a lot of fun.
That was John Wu, president of AVALabs. Coming up next, we are going to talk to CoinDesk's Nick Day about the latest in regulatory news and acquisitions. It's going to be fun. Stick with us.
CoinDesk Indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk Indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
CoinDesk Bitcoin Price Index, XBX, has been instrumental to Grayscale, enabling investors around the world to access Bitcoin through a regulated, familiar product.
CoinDesk Indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
Hey, welcome back. It's time to check in with Nick Day. He's CoinDesk Managing Editor of Global Policy and Regulation. Hello, Nick. How are you this fine Tuesday?
Good morning. I'm good. How are you?
Nick, reminisce with me. This morning when the news came out of FTX acquiring LedgerX, I think, for the if you know crowd, LedgerX was a nice blast from the past. There was all this drama in 2019 that I was seeing in the CoinDesk archives. Can you just fill me in on why LedgerX is an interesting story in the annals of crypto lore?
Yeah, I mean, LedgerX has been kind of one of the pioneers in trying to get crypto derivatives launched legally in the US. And, for a while, it seemed like they could have been the first to launch physically delivered Bitcoin futures, meaning, you place a bet in the price of Bitcoin, and if you are correct, you receive the actual Bitcoin at the end of the contract. So they were kind of, spearheading a lot of efforts around this. But, 2019 happened. There was a lot of drama around whether or not they had permission to launch these, futures, whether or not, there was any, quote, personal animus between the founders of LedgerX and the CFTC head at the time. And 2019 ended with the founders of LedgerX being ousted and replaced by, a former member of the team. So yeah, 2019 was a pretty crazy year for the company, but this move I think makes a lot of sense because LedgerX does have all of the licenses necessary to launch Bitcoin futures or other crypto derivatives in the US, and FTX I think makes a lot of sense that they would want to expand in this area.
Yeah, Nick, when you look at the numbers, Deribit, which is the largest exchange, they have about $7 billion worth of open interest contracts right now, just in Bitcoin alone. And LedgerX is something like 200-something million. So it's 1/26th of what Deribit has. What does this mean, though, for FTX's expansion, as you were just alluding to right before, into the U.S.? The U.S. is kind of, they've said, is an emerging market for FTX. So what does it mean here? Are they're just buying the license, and obviously not they're not paying for the great business that LedgerX has been providing, but more about the license? Where do they go from here?
No, I think it's a couple different things, right? I mean, first off, LedgerX does have a actual business built around these products. So, I imagine FTX is going to try and tap, its own broader market and see if they can get more folks who are interested in these kinds of derivative products. So it's, not just futures, but also options and puts and stuff. LedgerX also has, I think, last year we reported that they have permission to expand beyond just, purely crypto derivatives. So if FTX wants to look past just crypto products, then, LedgerX might be a way of doing so and, further expanding their customer base to not just, crypto native folks, but also to people who are trying to trade, futures, more traditional futures and options products. But also LedgerX has, spent years building out the technology to, offer these products. So I have to imagine that if FTX is interested in, expanding to this particular sector of the market, then they don't just want the licenses. They also want, the technology stack to kind of streamline their launch, to make it easier, or to, just build upon.
A really interesting development in the expansion of Sam Bankman-Fried's trading empire. We're certainly going to watch this one closely and see if they can get derivatives to click in the U.S. market. Thanks, Nick. It's good talking to you. I'll see you later on Slack.
Thank you. See you around.
Cool. That was Nick Day, Managing Editor of Global Policy and Regulation. And please sign up for Nick's State of Crypto newsletter on CoinDesk.com for all the latest in crypto policy and regulation. That's it for today on First Mover. Hey, thanks so much. My co-host, Lawrence Lewitton. He's the managing editor of Global Capital Markets. I am Zach Seward, the deputy global news editor at CoinDesk, and we are going to do this again tomorrow. But before then, stick with CoinDesk TV at noon for The Hash, the show I'm usually on, and All About Bitcoin, 3 p.m. Eastern, also on CoinDesk TV. This has been First Mover on CoinDesk TV, and we will see you soon. Have a great day.